Hi Charlie, I hope your weekend went well. In this presentation, I will introduce about the financial models of growth capitals for textile manufacturing company. On page 2 is the agenda. First of all, I will introduce about the case study background. Then we will discuss about the financial models assumptions, and I will discuss about the performer of the profit and loss statement, uh, then the balance sheet, and the projection for cash flow statement. And last but not least, we will discuss about the investment assets together with the sensitivities analysis. Moving on, page 3 is the introduction of the case and the financial models. The subject companies is experiencing a strong market fundamentals for textile products. Uh, they need further capital to fully realize their potential growth. The additional equity investment will be deployed to repay their current debt, their existing debt, and to invest into some short-term business plan. The company's managers require a 5-year integrated financial models to consider the financing features of the next phase of growth together with some operational assumptions. This model will include the interlinked uh, three three financial statements of profit and loss, balance sheet, the cash flow statement, and this will provide the returns on investment calculation together with the sensitivities analysis so that the company's board of directors will make their decision on the this capital growth investment. On page 4 is the input for operations. You can see on the tables in the slide deck on this page. So the sales revenue in the beginning of the investment period uh, is 97 million. EBITDA is 9.5 million. We have the assumption for sales growth as percentage, EBITDA margin also as percentage, stock as percentage as sales, data as percentage as sales, to name a few. Based on the table, looking at the table, you can see that sales growth is projected uh, as 10% for the first 2 years, and then 8% for the following 3 years. After that, revenues growth is forecast aligned with the inflation, the market inflation of 4%. Uh, for EBITDA margin is projected uh, to improve in the first 2 years from 16% to 17%, and then stabilize thereafter at 18%. Page 5 introduce about the input, options, and use of capitals and other assumptions. Take a look at the table on the left-hand side for the use of uh, capitals. The proposed investment is estimated at 33%, 33 million, and would be used to provide cash of 10 million to the business and paid out 22 million of the for the of the existing debt of 72 million. Pay transaction fees cost 1 million. For the source of the fund, the proposed investment would come from two main sources um, of fund. That is the ordinary equity investment of 15 million and the long stock of 18 million. Taking a look at the for the debt assumption, long-term aid has a 5-year maturity and bears an interest rate of 12% annually. Long stock is a bullet loan with 9 years maturity and bearing an interest rate of 20% annually. For the assist assumption, what is provided below the debt assumption, the proposed investors assist time frame is 5 years from the date of the transaction. The assist enterprise value to EBITDA multiples is assumed to be 8 times, and the transaction includes warrants giving the investor the option to increase its exit stake at the time of exit by purchase an additional 4,000 shares. Other assumptions are, are the interest are about the timing. The interest is paid at the end in the year in which it is incurred. Tax is tax will be paid a year after it has been incurred, and assets will happen at the end of the years of a certain period of the assessment time. Moving on, page 7 is the performance of the profit and loss statement in the next 10 years. You can see the table, the calculation in the table here. The revenue grow significantly from during the investment period from 97 to 105.2 100 105.106 million. EBITDA also increased nearly double from 9.5 million to 19 million. The business is projected to grow consistently with 9.4% and compound annual growth interest for sales growth and 6.6% compound annual growth interest for EBITDA growth. On page 8, this is the balance sheet performer. So you can see that in this calculation, debt is repaid within 5 years, and the cash balance situations look very positive. The net asset value is also increased over time, and for the network built up very well over the investment horizon. Is achieving about 108 million at the end of year 10. It's more than triples the network valuation in the beginning of the investment. This investment period. On page 9 is the performer for cash flow in the next 10 years. The company cash position improved significantly during this investment horizon. Operating cash flow achieved 19 million at the end of year 10, and cash flow available for debt service is on time positive throughout the assessment time. Page 10 provides the financial outlook for the investment assets. You can see here from the calculation, EBITDA increase over time. So a delay in if the assets delay, will result in a higher enterprise value and consequently a higher equity value. So at the end of year 10, equity values is estimated at 209 million, from which is an increase of more than 200% from year 1 of 80 million, which is very impressive. Page 11 discuss about the investment returns. So at the end of as discussed in the assist assumption. So our calculation for the existing year 5, for year 5 investment assets, the IRR achieved 30% and equity multiples achieved reached 3.3 times, which very impressive performance. Taking a look at the table on the right hand side is the sensitivities for IRR and multiples analysis. You can see that as the assets for equity enterprise values to EBITDA multiple increase from 7 times to 9 times, both IRR and multiples equity multiples increase, and as when for the you can say that the IRR decrease over the times. So if the assess year is delayed, we will result in the reduce in IRR. So that resonate with the principles of time values of money. In the other side, EBITDA increase over time. So in this situation, if there's a delay in the delay in the assets decision, the decision to delay the assets will result a higher enterprise value and consequently a higher equity valuation. So it depends on the board of director investment measure whether they consider IRR or EBITDA in their calculation to make their further decision, to make their final decision. Moving on page 10 is the reference that I use to build this kind of models and to understand the dynamic between the cash flow between the financial statement and to calculate the return on investment together with running the sensitivities analysis. So I have great time learning about building how to build in the capital growth for projection, financial projection for capital growth investment. I try to improve my presentation skill, and I do believe there are a lot of improvement area in my performance. Please let me know if you have any feedback or comment that will help me significantly in my to develop my skill. Thank you for your listening.